Okay, small stock dividend. We're going to be looking at that now. So basically less than 25%. What we're doing is not paying a cash dividend. We're going to issue more stock to our stockholders instead of paying a cash dividend. So if there's a 10% stock dividend and you have 100 shares currently, you'll end up with 110 shares, 10% more. Let's look at how it works as far as the company's entries go. Stockholders' equity section on April 1st follows. We have common stock, $5 par, 375,000 shares authorized, but 200,000 shares are issued and outstanding, $1 million. Paid in capital of excess par value, which is $5, common stock, 600,000, retained earnings, $833,000. Total equity, $2,433,000. Now they're going to issue a 10% stock dividend. 10% stock dividend. Market share is $20 prior to the dividend. Armed with that information, I think we're ready to go. So what I do is I do the 2 credits. I know there's a 3-part entry, 1 debit and 2 credits. I do the common stock and the paid in capital first. Common stock will be, well, first off, how much is it? How many dividends do we have? Let's figure that out. Let me get drawing. We want blue. Okay, so we have 200,000 shares. We have 200,000 shares times 10%. And that would be 200,000 shares. No, 20,000, 20. Ugh. I'm writing down the same number again after multiplying by 10%. Crazy. I've been recording videos all day. All right, 20,000 shares times $5 par value. 20,000 shares and the dividend, stock dividend, times $5 a share. So that means common stock is going, a credit entry to common stock is $100,000. So common stock is going to increase with a credit entry of $100,000. You can see the math here, but let's look at it in the problem, because that's where you're going to be working at in the future on your own, is with problems without the solutions, right? So it says the market value is 20. And remember, additional paid in capital is whatever the value is, whatever transaction we've been doing so far has always involved selling stock or treasury stock. So when we're selling stock at an amount over the par value, we go into additional paid in capital. Well, in this case, we're not selling stock. The theory applies and remains. The market value, if the market value exceeds the par value, that goes to additional paid in capital. Well, in this case, 20 minus 5 is 15. $15 a share is additional paid in capital for each share. $15 times 20,000 shares is $300,000. Well, where's this coming from? We're not selling it, right? We're not like debiting cash, right? So normally when we sell it, let me just get out of write mode. Normally we sell it, we sell it, we debit cash, woo, we raise money. Well, in this case, we didn't raise money. We're just issuing more stock. So we have to take it out of somewhere, and what we do is we take it out of retained earnings. Retained earnings has a credit balance. The normal balance is credit. So when we debit, we're really pulling money out. We're lowering the retained earnings balance by $400,000. Got to come from somewhere. All right. So let's talk about how that looks on the balance sheet, right? So as you can see here, 1,600,833,000. 1,600,833,000. So the equity section before the stock dividend, small stock dividend, this is it. I'll just give you a minute to compare the two. You look at the notes of the screen. After, let's talk about that because that's very important. After. So we had common stock that was $1 million. now after the small stock dividend, it's $1,100,000 because this $100,000 increased it. We have paid in capital of $600,000, but now it went up by $300,000, and now it's $900,000. We had $833,000 in retained earnings, but we lowered it. We reduced it because we debited retained earnings. Now it's $433,000 after. If you add these three numbers up, it still totals $243,000. So essentially what we did was we just rearranged the decks on the chair. We rearranged the chairs on the deck. I said that backwards. So we pulled out the stock, small stock dividend essentially came from retained earnings. Essentially came from retained earnings. No cash is involved. We just basically pulled out the $400,000 from retained earnings, put $100,000 of it in common stock, $300,000 of it in additional paid in capital. And that's how this one works. And I don't believe I'm going to work any more videos at this time. This is recorded summer of 22. I don't think I'm going to record the rest of the a recording for the rest of the problems at this time. So if you have any questions on small stock dividends, again, that's less than 25%. This was a 10% one, so it's under 25%. Email me or anything else with your studies. Keep up the good work.